Okay, now we talked about simple ABCs. Now we're going to get a little bit more in depth with doubles and triples. So we're going to start with doubles here. And a double is two three-wave cycles joined together with a connector wave. And we'll label that connector wave as an X wave. There's 7 swings in all. And we're going to label these as WXY. Now, when Y extends 162%, we will project a triple. And I think I might have forgot to mention this part on the ABCs. If wave C extends 162%, we will project a double. Okay, and we'll show that here in a moment, but the same principle applies. If we do not see divergence, we will project a continuation. Okay, so now let's go ahead and take some time to look at these charts, because once you really know what you're looking for in the market, once you really start to look at these patterns and do the measurements, you'll really be amazed. I mean, obviously, there's always going to be some exceptions, so you have to remain flexible. And that's where we differ from Elliott wave theory. Elliott wave theory is extremely rigid, meaning if any of the rules get broken, you're not supposed to be able to qualify it at all. The problem with that is when you have these intraday volatile things that happen, or when something volatile comes into the market that changes a pattern or causes an overlap, you're stuck. You're stuck. So essentially what happens is you end up trying to prove everything and forcing these wave counts when it's just not there. It's just not there, but yet a lot of traders are still forcing these counts to try to fit in with these very rigid rules. Okay, and I think you're going to see from what I'm going to show you how the market actually does move. And it does it enough to give us a high probability, but we also understand that there are things that can come into the market that can cause the market to break these patterns or not quite fulfill them. So we're not going to be as rigid with it. It's a probability. Okay, we're looking for highly probable setups to make money in this market. Okay, we're not looking to be perfect forecasters. And that is the key to remember here. All right, so let's go and look at the charts. Let's go ahead and look at the charts here. I'm going to pull down, this is just a Euro New Zealand dollar chart. I'm just going to isolate this particular cycle right here. Okay, this cycle. And actually I'm really going to back out and look at this this entire cycle right here, because this is what we call an extended cycle, and we'll show you that in a moment. And this is where we will project a more downside movement. But first things first. First things first, we want to look at these particular cycles in here, each one. And you're going to start to see just how patterned this market actually is. Let's drill in a little bit closer, and I'm just going to, whoops, there we go. I'm just going to do this here, and we're going to look right here at this cycle, right here. Okay, right here. Now we talked about a simple ABC. Okay, we talked about a simple ABC. Okay, a simple ABC at this degree would be actually right there. Now a double, we have an X-wave connector, and we go into a second ABC. That's a double. Okay, this is a double at this smaller degree. Now what you'll start to see is when you measure this, remember we talked about equal legs, 127. So from our low to our high, okay, here's our bottom here. Here's our equal legs level. This is where the market found support, made a correction. Let's measure that. Measure that for the next cycle. Equal legs, 127. Right now, let's go a little bit further here. Let me go ahead and get rid of this. So you saw a double in this cycle. Now we're looking at this overall cycle is actually a double as well, but so is this right here. All right, so we had a three-wave move. Now obviously this fell a little bit short, This fell a little bit short of the equal legs level, and that's actually in itself is a bearish indication. Okay, when we measure this and we see it falls that way short, this short of making that equal legs movement, that's bearish on this pullback. Okay, so we would look to sell this pullback anyway. Now, let's go ahead and measure the entire cycle. Here's that three-wave cycle we just talked about, measured back to the correction, and the next three-wave cycle, equal legs 127. Okay, now let's go ahead and measure the entire cycle from here. This whole degree. This whole degree. You can see we came through the equal legs 127. Let's pull in the 162. Didn't quite make the 1618. But nevertheless, pretty close. Okay, pretty close. We extended, had a little bit more strength to the downside here. Now, what else do we notice? What do we notice here? We had a little bit more strength to the 127. Right here, this 127. We don't see divergence. There's no divergence here. Okay, so we're going to maintain a bearish outlook. We're going to maintain a bearish outlook. And now we have a corrective setback and another X wave, and we'll call these waves squeeze waves a lot of times because a lot of times these X waves can be very sharp and look to squeeze folks out of the market. We would pull back our Fibonacci retracements on the entire swing, and you see the 62% fib is where we retraced to. And then we continued to the downside. Okay, so now I've backed back out. We're going to look at this particular cycle right here. And we're going to put our measurement on this from our corrective high to the low to our next corrective high. And you can see we moved just about that equal legs level. Right here. This is equal legs. Okay, so you see three-wave cycle, connector, three-wave cycle. That's a double. Okay, that's what we call a double. And this will be labeled as a W wave. And don't worry about the degrees. I'm just throwing some degrees here. The labels, not the proper label degrees, I should say. So WX. This would be potentially a Y wave or a completed cycle. Or a completed cycle. Now, what happened here? Do we see divergence? No. We don't have any divergence here. Did this cycle extend? Let's measure the entire cycle. Let me get rid of these lines. Let's measure the entire cycle here with the 1618. Did we extend? Absolutely. Absolutely. This leg extended through the 162% Fibonacci projection of the initial W. So Y extended. We have no divergence. That gives us a bearish outlook. After a correction, and this is a live market right now, so we can't go any further. Okay, but this is a corrective cycle right now. We would look in this area for sure. This is a 62% fib. We have no divergence. We have an extended cycle. So on this pullback, we are bearish. And if you look at this cycle here, now there's alternates in this, but right now I'm just going to call this a triple. It's a live market, so obviously, different things could happen here. Right now I'm just going to call it a triple. We would label this as a potential W, X, Y, X, and this could be the end Z. And if we measure this, see how the market moved? Oops, let me get rid of some of these lines so we can actually see this. And I'm going to get rid of that 1618 for now, just so we can see this clear. Equal legs. Right to the 100%, that's equal legs. Let's measure the next cycle. Sorry about that, hit the wrong button. All right, the next cycle right here. from our high to our low. Get rid of that 1618 so we can see this better. Equal legs 100%. Okay, folks, very, very common pattern in the market. Gives us a very high probability when we're using these patterns and divergence to trade with, to profit. Are there times when it's not going to work out perfectly? Absolutely. Are there times when the market's not going to be quite as symmetrical? Absolutely. Because as we learned when we talked about why the market is patterned and why patterns can fail, we know that there's outside events. There's outside events that the markets react to. Okay, but there's enough symmetry in the market to be able to see that human behavior and build a strategy around it. And that's what we've done. I mean, folks, look at the cycles in the cycles here. Look at the cycles inside the cycles. All right, so let's measure this one right here from the high to the low. Equal legs, 100%. Okay, equality. You're going to see it a lot. Let's have a look at this one. Let's just see if this one measures up. From our low to our high. Equal legs, 127. Let's drill into this particular cycle. I'm just picking cycles now so we can really show this. Let's drill into this particular cycle here. All right, you can see initial three-wave movement right here. And we're getting really small into the cycle here, I know it, but you can see that extended, which was bullish. If we're looking at this on a 5-minute chart, you would see this particular leg extend, which is bullish. So in this pullback, we look for another cycle high. Then we can measure. We can measure from this cycle. Oops, there we go. From this cycle here, equal legs, 100%. And let's take the measurement on this cycle, from the high to the low, equal legs, 100%. ABCs, doubles, and triples, folks. That's how the market moves. And we're going to continue throughout the rest of this course to show you this. Remember, I said I would give a lot of examples. So once you finish this course, there just won't be a doubt. You won't have a doubt. Another cycle right here. I just backed up a little bit on the same pair. Just back the chart up a little bit. And you can see if we measure this particular swing, pull that back right here, equal legs. Three-wave cycle, equal legs. Then we had this setback. Now, we can disregard this spike as probably an intraday, some type of intraday release right here. All right, so if we just disregard that spike, measure this three-wave cycle, and pull this back to the close right here. Equal legs 127 for the next cycle. Okay, see how it moved right to equal legs 127. Now let's take the entire cycle here. Let's measure that. Oops. Try it again. From our high to our low. Let me get rid of some of this here. All right, sorry about that. Now let's measure this from the low. Pull that back. The next three-wave cycle, equal legs 127 before the turn. And here, what do we see? We have divergence. Okay? Price moving lower. MACD cycling higher. This is a double. This is a double. Okay, this is another situation where we label three waves to the downside. We label that as a W wave, X wave setback, and the second part of the double. All right, so you can see the double has a three-wave decline, an X wave, basically just connecting another cycle. And the best thing you can really do, folks, is to go through the market on your own and identify these particular patterns. Okay, now here's the 4-hour chart. Here's the 4-hour chart here of the same pair, the Euro Kiwi. Let me just get rid of that here. This is where we were just looking on the 15-minute chart just a minute ago. We were looking right in here at these little small tiny cycles. Now I just wanted to back out on this 4-hour chart and look at this entire cycle here. Look at the entire cycle. Okay, so you can see this is made up of a 3-wave cycle and a connector X wave, okay, and then another cycle to the downside. Let's do the measurements on this. Okay, let's do the measurements. And for this, I'm going to pull out the extension, that 162, because price right here from the low, pull it back to the high, we extended 162%. Here was equal legs 127, pull back, continue to extend this cycle to the 1618. That is bearish. That is bearish. This is a corrective setback. That's what we're going to look at. This is a corrective setback. Okay, so what happened at that point? The market retraced 62%, okay, right to that 62% fib in this case, and then continued to the downside for another cycle. This is an overall larger degree double. This entire pattern is a double. Okay, and it will be labeled right here as a W. Really struggling with these charts today. I apologize, folks. Okay, let's try that again. This would be a W, X wave, and then the second half of the double, which we would label as a Y. We remembered W extended. Okay, this leg extended here. And this was actually a smaller degree W. A smaller degree W that extended, which made us label this as a larger degree W, if that makes sense, and we'll get into the labeling here in a little while. So we were looking for a corrective setback and a continuation to the downside. Now let's go ahead and measure the entire cycle from our high to our low, pull it back for X. And how about that? Equal legs 127. And what do we get at the bottom? Divergence, bullish divergence. And now that you know what you're looking for and you go through the markets, you'll really start to see it. It'll really become clear. Okay? So folks, those are doubles. Next, we'll look at triples.